Your 401k just lost money. Not because you did anything wrong, not because you picked bad stocks, because of a tariff announcement. And if you opened your account this week and felt your stomach drop, I need you to hear something before you do anything at all. Do not touch it. I will explain exactly why in a moment. My name is Donald Cash, double chin, gold tie, a dog named Jerome who somehow always looks calmer than me during market downturns. And this week, I want to talk about tariffs. Specifically, what they are, what they actually do to your 401k, and most importantly, what you should and should not do right now. Because right now, a lot of people are panicking. And panicking with a 401k is one of the most expensive mistakes you can make. I know because I have made expensive financial mistakes before. I am practically an expert at it. So let me save you some of the tuition I already paid. First, let me tell you what actually happened. On the 2nd of April 2025 a day, the White House called Liberation Day, President Trump announced sweeping new tariffs. A 10% blanket tariff on all imports, plus additional tariffs on 60 specific countries. China got hit especially hard, eventually reaching tariff rates above 100% before partial negotiations began. The market reaction was immediate. The S&P 500 dropped nearly 10.5% in the days that followed. The Dow Jones fell over 2,200 points in a single day. The Nasdaq briefly entered bear market territory, down more than 20% from its December 2024 high. And retirement accounts across America took a direct hit. According to Fidelity, which manages more 401k plans than anyone in the country, the average 401k balance fell 3% in the first quarter of 2025. The average IRA balance fell 4%. Retirement accounts collectively lost close to $3 trillion in value during the worst of the volatility. $3 trillion. Victor Fettes, a 54-year-old man from Georgia who had literally just retired, opened his 401k and found he had lost $58,000 in 2 days. He said, and I am quoting, "If this continues, I cannot stay retired." That is a real person. That is a real number. And that is a very real fear that I think a lot of you are feeling right now. So let me explain what tariffs actually are, because I think a lot of people are reacting to something they do not fully understand, and I include my former self in that category. A tariff is a tax. Specifically, it is a tax imposed by the government on imported goods. When the United States places a 10% tariff on electronics from China, American companies that import those electronics now pay 10% more to bring them in. Now, here is where I want to be precise, because the original script said companies simply pass all costs to consumers, and that is mostly true but not completely. In reality, the tariff cost gets split 3 ways. Some of it gets absorbed by foreign exporters who lower their prices to stay competitive. Some gets absorbed by American importers who accept thinner margins. And yes, some gets passed to consumers as higher prices. How much lands on the consumer depends on the product, the competition, and the negotiating power of each party. The net result for the stock market is the same: investors see profit margin pressure, higher consumer prices, slower spending, and possible recession risk. And they sell. Fast. Which is why your 401k dropped. Not because your investments are bad, because the market priced in fear. Now, here is where I need to separate the short term from the long term, because this is the distinction that determines whether you make a smart decision or an extremely expensive one. Short term, the market is reacting to news, to uncertainty, to fear. And here is something most people do not realize. Markets hate uncertainty more than they hate bad news. They can price in bad news, a bad earnings report, a rate hike, a recession. The market can calculate those and adjust. What the market cannot price in is things it does not know. Right now, there is enormous uncertainty about which countries will negotiate trade deals, how China will respond over the next 6 to 18 months, whether tariffs will cause significant inflation, and whether the Fed will cut or hold rates in response. That uncertainty equals volatility. That volatility is what you are seeing in your account right now. Long term, the fundamental question is whether American businesses will continue to generate profits over the next 15 to 20 years. If you are 50 years old, your 401k has a time horizon of at least 15 to 20 years before you need to draw it down completely. That is the time horizon that matters. Not this week, not this month, not even this year. Let me give you a historical reference point, because history is the most calming thing I can offer you right now. Every major market shock in modern history felt catastrophic in the moment. The 2008 financial crisis. The S&P 500 fell 57% from peak to trough. 57%. If you had $100,000 in your 401k in October 2007, by March 2009, you had $43,000. People panicked, people sold, people moved everything to cash. And then the market recovered. By 2013, 4 years later, the S&P 500 had fully recovered its losses. By 2019, it had more than doubled from the 2007 peak. The people who sold at the bottom locked in their losses. The people who stayed the course recovered and then grew. COVID. March 2020. The S&P 500 fell 34% in 5 weeks. 5 weeks, 34%. And then it recovered in 8 months. By end of 2020, it was at all-time highs. The tariff shock of April 2025? The S&P 500 fell around 10.5%, and then a partial rollback was announced, and the market surged 9% in a single day. One day, 9%. The people who sold during the panic sold at the bottom and missed the recovery. Now, I want to add one important nuance here that the original version glossed over. These historical comparisons assume you have time on your side. If you were 63 in 2008 and needed to start withdrawing from your 401k in 2009, you did not have 4 years to wait for the recovery. You were selling at the bottom because you had to. This is called sequence of returns risk. And it is real, and it is specifically why the right answer to this market moment is different depending on your age and how close you are to actually drawing down your account. I will come back to this. It matters. History does not repeat exactly, but it rhymes loudly. Now, I want to address something directly, because I can hear the objection forming. Donald, this time is different. Tariffs are structural. This is a fundamental shift in the global trade order. And I want to be honest about this more than the original version was. This objection deserves real respect, not dismissal. The phrase "this time is different" is famous in investing as a warning sign. It is what people say right before they make an emotional mistake. But sometimes, things actually are structurally different. The 2008 crisis revealed genuine structural flaws in the financial system that took years to work through. So what is the honest answer on tariffs? The honest answer is, we do not know yet. What we do know is this: even in genuinely structural economic shifts, diversified, income-producing portfolios have historically been more resilient than concentrated growth positions. Dividend-paying companies still pay dividends during recessions. Johnson & Johnson paid its dividend throughout the 2008 financial crisis. Procter & Gamble paid its dividend through COVID. Coca-Cola has paid and grown its dividend for over 60 consecutive years, through oil shocks, financial crises, wars, pandemics, and now tariffs. But I want to be careful here. Dividend cuts do happen. In 2008 and 2009, many individual companies cut or suspended dividends entirely. Banks were the most notable example. What held up were the dividend aristocrats companies, with long histories of consistent dividend payments, strong balance sheets, and dominant market positions. Not all dividend stocks, the quality ones. This distinction matters. Chasing the highest yield is not the same as owning resilient dividend payers. A 7 or 8% yield on a financially stressed company is not the same as a 3% yield from Coca-Cola. If you own quality dividend ETFs like SEHD, which screens specifically for dividend consistency and financial strength, you own the resilient kind. If you are reaching for the highest yield available, that is a different, riskier position. Now, I told you I would come back to sequence of returns risk. Let me do that, because this is one of the most important concepts for the 45 and older crowd, and most financial videos do not explain it clearly. Sequence of returns risk is the danger that you will experience a major market downturn right at the moment you start withdrawing from your retirement accounts. Here is why it matters so much. Imagine two people, Both retire at 65 with $500,000. Both average 7% annual returns over 20 years. Person A gets the good years first. Strong returns in their 60s, weak returns in their 70s. Person B gets the bad years first. A major downturn right at retirement. Strong returns in their 70s. Same average return. Same starting amount. Person A runs their portfolio for 25 years. Plenty of money remaining. Person B runs out of money in year 17. Same numbers, different sequence, completely different outcome. This is why the blanket advice stay the course is correct for a 50-year-old still accumulating, and potentially devastating advice for a 65-year-old who just retired and is now drawing down. Victor Fetis is 54. He just retired. He is in the highest risk sequence of returns zone. For Victor, the correct answer is not just stay the course. The correct answer is make sure you have a 2-year cash buffer so you never have to sell equity at a depressed price just to pay your grocery bill. Draw from cash while the portfolio recovers. Do not touch the invested portion during the downturn if you can avoid it. This is the bucket strategy. Bucket 1, cash for immediate needs, 1 to 2 years. Bucket 2, conservative income producing assets for years 2 to 5. Bucket 3, growth assets for 10 years plus. When the market drops, you draw from bucket 1. Bucket 3 stays invested and recovers. This is what protects people like Victor. Not selling everything, not hiding under a mattress. A thoughtful structure that separates short-term needs from long-term assets. Let me talk about what the tariff environment means for different types of investments. Because not everything goes down equally, and understanding this helps you make better decisions. International stocks most directly exposed. Tariffs reduce global trade volumes, hurt foreign exporters, and create currency dynamics that work against international equity returns for American investors. This is where most of the tariff risk concentrates. Domestic large-cap dividend stocks, more insulated. Companies like Procter & Gamble or Johnson & Johnson have pricing power. They raise prices. They have been doing it through every economic cycle for decades. One important nuance: domestic companies that rely heavily on imported components, even if they sell domestically, face real margin pressure. An American manufacturer that sources parts from China faces higher input costs, even if their customers are entirely American. Check what your holdings actually make and where they source it. REITs, real estate investment trusts, relatively insulated from tariffs in the short term. Rental income does not depend on global trade. However, if tariffs cause broader economic slowdown or recession, commercial real estate faces rising vacancy rates. And if tariffs cause inflation and the Fed responds by keeping rates higher for longer, REIT valuations face pressure because they are sensitive to interest rates. REITs are defensive in a trade war, less defensive in a prolonged inflationary environment. Know which scenario you think is more likely. Bonds and treasuries. In a flight to safety scenario, treasury bonds go up as investors sell stocks and buy safety. That is what happened initially in April 2025. However, and this is the nuance the original version missed, if tariffs cause inflation to rise significantly, the Fed may not be able to cut rates aggressively, which means bonds face their own headwind. In 2022, both stocks and bonds fell simultaneously because inflation was high and the Fed was raising rates. That was painful for the traditional balanced portfolio. If tariffs cause sustained inflation, that 2022 scenario could repeat, which is one reason inflation-protected assets like I-bonds or Treasury inflation-protected securities become more interesting in this environment. Tech stocks, most exposed among domestic sectors. Hardware manufacturing is heavily concentrated in Asia. Chips, screens, components. Higher import costs directly hit margins for Apple, for consumer electronics companies, for semiconductor manufacturers. This is a meaningful structural headwind for tech if tariffs persist. Energy, complex and worth understanding. Tariffs slow global growth. Slower global growth reduces demand for oil and commodities, which hurts energy prices and energy company revenues. On the other hand, American domestic energy producers face less direct tariff exposure than importers. It is sector-level headwind with company-level variation. The summary that holds: domestic dividend payers with pricing power, REITs with strong balance sheets and residential focus, and inflation-protected bonds are the more resilient positions in a tariff environment. International equities, growth tech with overseas supply chains, and traditional long-duration bonds face the most headwind. I want to say something about fear, because I think it is important. Fear is a reasonable response to what is happening. Watching your retirement account shrink is scary. Watching the market swing 1,000 points in a day is unsettling. Reading headlines about recession and trade war is stressful. And here is the thing, that fear is designed to make you act. It is your brain saying, do something, fix this, make the bad things stop. But in investing, acting on fear is almost always the wrong move, because the market has already priced in the fear. The drop you already saw, that was the market processing the same information you are reacting to now. When you sell after a drop, you are selling to someone who believes things will recover, and historically, they are right more often than the person who is selling out of fear. The most expensive thing you can do in a market downturn is sell. The second most expensive thing is check your account 17 times a day and let anxiety drive your decision making. The least expensive thing is nothing. Continue contributions. Let dividends reinvest. Trust the time horizon. Easy to say. I know. I checked my account 7 times in 2 days. I am not pretending this is easy, but knowing what the right thing is, and then doing the right thing despite the fear, that is the actual skill. Let me address the recession scenario directly. What if tariffs do cause a full recession? It is a real possibility. Economists who track leading indicators, things like the yield curve, purchasing manager indexes, and consumer sentiment, are not dismissing this. Goldman Sachs raised their recession probability estimate to 35% in April 2025. JP Morgan raised theirs to 60% before the partial rollback. These are not fringe views. So what actually happens to investments in a recession? Stock prices fall, usually significantly. The average recession-related market decline is around 30% from peak. Some are shallower. 2008 was much deeper. Corporate earnings fall, which is the actual driver of stock prices long term. Some dividends get cut. Companies under pressure preserve cash. This happened in 2008 to financial stocks specifically, and to some industrial companies. What does not happen historically is permanent impairment for diversified holders of quality assets. The companies come back, the earnings recover, the dividends get restored. In 2009, if you kept buying S&P 500 index funds during the crash, you bought at the cheapest prices available in a generation. By 2019, those shares had tripled. Recessions feel like the end. Historically, they are buying opportunities, but only if you have the cash buffer to not be a forced seller, which brings me back to the bucket strategy. If you have a cash buffer, a recession is an opportunity. You keep drawing from cash. Your invested portfolio stays intact, and when prices recover, and they have, every time you benefit. If you do not have a cash buffer and you need monthly income from your portfolio, a recession is genuinely dangerous, because you are forced to sell at the worst possible time. The answer is not to panic sell before the recession. The answer is to build the buffer before you need it. Here is what I actually believe about where we are right now, honestly. The tariff situation is genuinely uncertain. Nobody, not the Treasury Secretary, not the Fed, not any economist I have read, knows exactly how this plays out. But here is what I am personally doing with my portfolio. I am not selling anything. I am maintaining my regular monthly contributions. I am keeping dividend reinvestment on. I have verified that my cash buffer, 2 years of living expenses in a high-yield savings account, is intact and untouched. I have checked that my allocation still matches my target. It had drifted slightly toward equities given the run-up in 2024. I am letting it drift back down naturally as bonds slightly outperform equities in the current environment. Not rebalancing aggressively, just monitoring, and I have closed the portfolio app except for once-a-week check-ins. That is it. That is the full list of actions. Boring, deliberate, calm. So here is Donald's actual action plan. Step 1. Do not sell in a panic. If you have done nothing yet, keep doing nothing. That is correct. Step 2. check your allocation, not your balance, your allocation. What percentage is in stocks versus bonds versus cash? Does it match your timeline and your actual risk tolerance, not the risk tolerance you thought you had when everything was going up? If your allocation has drifted, a calm rebalance to target is fine. Not an emergency. A scheduled maintenance. Step 3. Build or verify your cash buffer. The size depends on your situation. Still working 10 plus years to retirement. 3 to 6 months of expenses in cash or high yield savings is sufficient. A market downturn does not affect your ability to pay bills from your salary. Within 5 years of retirement, 1 year of expected retirement expenses in cash. 2 is better. Already retired, 1 to 2 years minimum. This is non-negotiable if you want to avoid sequence of returns risk. Step 4. Keep contributing if you still have employment income. Every dollar you invest right now buys shares cheaper than 6 months ago. Dollar cost averaging is most powerful when prices are down. Step 5. Stop checking daily. I will say this again because it is genuinely difficult and genuinely important. Your retirement portfolio is a 20-year project. Checking it with hourly data is like checking the weather every 5 minutes while trying to plan a vacation 6 months from now. The data is too granular to be useful, and it triggers emotional reactions that cost money. Once a month. That is the right frequency for most people. I want to come back to Victor Fetis one more time. The 54-year-old man from Georgia, just retired, lost $58,000 in 2 days. He said, "If this continues, I cannot stay retired." I do not know Victor's full situation, but I know how to think about it. The critical question is not, how much did the portfolio drop? The critical question is, does Victor have a cash buffer? If Victor has 2 years of living expenses in cash or stable assets, the $58,000 paper loss does not change his ability to stay retired. He draws from cash. He waits. The portfolio recovers. If Victor does not have that buffer, and he needs to sell equity every month to pay bills, he is experiencing exactly the sequence of returns risk I described. And in that case, some reduction in equity exposure with guidance from an advisor may actually be the right call. The number going down is not the same as the money being gone. But that statement is only completely true if you are not a forced seller. If you are, build the buffer. That is the actual solution. One last thing I want to add that was missing from the original version. This is not financial advice. I want to be very clear about that. I am a guy with a double chin and a gold tie who shares what he personally does with his money. I am not a licensed financial advisor. I do not know your full financial situation. I do not know your tax situation, your health situation, your family situation. What I share is how I think about these decisions, and why, and what the data says historically. For specific advice about your specific situation, especially if you are within 5 years of retirement and we are in a volatile market, please talk to a fee-only financial advisor. Not a commission-based one. Fee only. They work for you, not for the products they sell. That is not me covering myself. That is me being honest about the limits of what one video can actually do for you. My tie is still on. Jerome is calm. My wife is doing her customary impression of someone who saw this coming. And the portfolio is still working. Down a bit? Yes. Paying dividends? Also yes. Being contributed to? Still yes. Cash buffer intact? Yes. Allocation checked and on target? Yes. That is what staying the course looks like. It is not exciting. There is no dramatic action. There is just quiet consistency in the face of loud noise. The noise is real. The fundamentals are also real. And over the long term, fundamentals win. Let the money do the work. Even when the news is loud, even when the numbers are uncomfortable, even when Greg's boat suddenly looks like a better investment than your 401k, it is not. Stay the course. If this video helped you think more clearly during a stressful week, subscribe. Because this kind of market environment is going to keep producing questions, and I am going to keep answering them honestly, with real numbers, real uncertainty, and a tie that is always too tight. And in the comments, tell me 2 things. Your age bracket just 40s, 50s, or 60s is fine. And whether you have a cash buffer right now, that is it. No dollar amounts required. I will reply to every single comment with what the right action looks like specifically for your situation. Every comment. Donald Cash, out.